In this video, I'm going to share with you the top 3 dividend concerns that most people have. Number 1, dividends are insignificant. Number 2, dividends are not guaranteed. Number 3, what happens to the dividend when the stock price drops? Hi, my name is Kanwal Sarai, and welcome to the Simply Investing Dividend Podcast. Let's get started with the first one. Most people believe that dividends are insignificant. Now, if you look at the screen in front of you, here's an example of a couple of companies, and this is their annual dividend per share at the time of this recording. So if we take a look at SiriusXM, you can see that the annual dividend is 12 cents a share. Apple is 92 cents a share. So when you look at these numbers, in the beginning, for sure, they look insignificant, right? You're looking at them, you're thinking, well, I'm not going to get wealthy from 12 cents a share. And in fact, these are annual dividends. So you have to hold on to these shares for a whole year just to get that 12 cents per share in the case of SiriusXM. So in the beginning, for sure, the dividends are going to look like that they're insignificant. But in fact, they are not insignificant. Why? Because of dividend increases. So let me share with you a personal story of mine. I bought 185 shares of TC Energy back in 2000, and the share price at the time was $13.40. So if you take the $13.40, multiply that by 185 shares, you can see that my total investment in this company was $2,479. Now, that's the amount of money that was at risk, right? Had the company gone bankrupt, I would have lost my complete investment of $2,479. So whenever you invest in a company, I mean, that's the amount you're putting in, your capital is the amount that's at risk. Now, I'm going to show you what happens to that risk over time. It's going to drop because of the dividends. So let's take a look. In 2000, so I'm just going to move this over so you guys can see the numbers on the chart. So in 2000, when I purchased the shares, the dividend was 80 cents a share. So if we take the 80 cents divided by my purchase price, my dividend yield was 5.9%. And in the first year, I made $148. The following year, the company increased its dividend. So let's take a look at that over here. Okay, and you can see that the dividend was 90 cents a share. So now the dividend yield, again, we're going to take 90 cents now, divided by my purchase price, was 6.7%. So you can see my dividend yield has gone up. And I made a little bit more money that year as well from this company. The company has increased its dividend every single year since I've owned it. The dividend today is $3.60. So if we take the $3.60 divided by my purchase price, you can see that my dividend yield today is 26.8%. I can't make 26.8% anywhere in a checking account, in a savings account, in a bond, or in a term deposit. So this is a great return on my investment. This year, the company will pay me $666 just for owning those shares. Now, it gets even better. Since I've owned these shares, I've received over $8,000 in dividends. Now, remember, my initial investment was $2,479, but I've received over $8,000 in dividends. The stock price today is around $64. Do I care if the stock price drops to $40 tomorrow, or $30, or even $25? No, of course not, because I've already more than made up my money with this investment. So you can see my risk was $2,479, my initial investment, and every time the company paid me a dividend, my risk went down. And then they increased the dividend, and my risk went down. And then the following year, I got more dividends, and my risk went down. So now the risk with this investment to me is 0%. Okay. Now you can see that the share price is $64. So the share is price, looking at the share price alone, the return on this investment is 377%. But when you add in the dividends, you can see that it's now over 700%. Now, to me, this is truly passive income. I don't have to work harder. I don't have to spend more time and research on this investment. I just hold on to the shares, and every time the company increases the dividend, my passive income goes up. And I've shared this with you in previous episodes. The dividend is deposited directly into your trading account when a company pays the dividend, right? So you can spend the dividend if you wish, or you can reinvest it. So it's truly passive income. More importantly, it's growing passive income, because every time the company increases the dividend, my dividend yield goes up, I make more money, and I didn't have to do any more work for it. Okay, so dividends are in fact not insignificant, but it does take time to grow the dividends. And that's why we, as dividend investors, we're long-term investors. We don't think in terms of weeks, months, or years. We think in terms of decades. Okay, so that's important. Okay, let's move on to the next one. The next top concern people will say is, well, dividends are not guaranteed. So why should I bother investing in dividend stocks? Okay. Now, they're absolutely true. Dividends are not guaranteed. Companies are under no legal obligation to pay you a dividend. Companies can reduce the dividend anytime they want, or they can cut the dividend altogether anytime they want. And we saw that in March of 2020 when the coronavirus hit. Companies like Disney cut the dividend, General Motors cut the dividend, Boeing cut their dividend completely, just eliminated it. So as dividend investors, how do we have the confidence to invest in dividend stocks when the dividend is not guaranteed? Okay, so for that, we look to the past. So you can see a list of companies on the screen here. Now, this is just a short list. I have a much larger list in the Simply Investing platform. But if you just look at this list on the screen right now, you can see that some companies have been paying dividends since the 1800s. Black & Decker has been paying a dividend since 1876. Coca-Cola has been paying a dividend since 1893. Okay. Now, more important than that is the next column over. The next column over is the consecutive years of dividend increases. So let's take a look at a company like Coca-Cola. They've had more than 59 years of consecutive dividend increases. Okay. This is really important, so I'm going to say it again. This is 59 years of increasing their dividend consecutively, year after year after year. Think about how many recessions we've had in the last 59 years, how many market crashes we've had in the last 59 years. But companies like this have continued to grow their dividend year after year. And remember, every time the company increases its dividend, that's more money in your pocket. So for sure, dividends are not guaranteed. But when we look at a list like this, we have confidence that companies like these will continue to pay us a dividend next year and hopefully increase the dividend in the future. Now, for those of you who are interested, the Simply Investing platform, we give you the consecutive years of dividend increases, and we give you the dividends paid since for every single company in the US and in Canada. So that's available in our platform. Let's move on to concern number 3. And most people ask, well, what happens to the dividend when the stock price drops? So let's take a look at that right now. So we're looking here at a company called Canadian National Railway, and we're looking at, it's 20 years worth of data here. You can see the stock price on the screen is in purple or a deep blue color. And you can see the stock price goes up and down all the time. And we see in certain places the stock price dropping by $5 a share, $10 a share, even $15 a share. And every time the stock price drops, what's happening to the dividend? The dividend is the orange line that you see on the screen. And you can see that the orange line continues to go up year after year after year after year. So regardless of the stock price, even when the stock price tanks, the dividend continues to go up. In fact, this company has had 25 years of consecutive dividend increases. So how can a company continue to pay you dividends and increase the dividends when their stock price drops? And that's because dividends are not paid from the stock price. Okay? It's important to know this. Dividends are paid from earnings. So as long as the company continues to make money, as long as the company is profitable, they will continue to pay you the dividends. Okay, so now let's take a look at the same company again. So the stock price is in sort of purple or very dark blue, and you can see the stock price goes up and down. The orange line is still the dividend, so we can see that the dividend continues to go up. What I've added to this chart here is now the earnings per share, which is sort of the light blue line. And so that is how much money the company is making every single year. So the blue line continues to go up. Then we see it drop. Okay, now this is normal. Sometimes companies will hit sort of a speed bump or a road bump and the EPS will come down. But then what we want to see over the long term is we want to see the earnings go back up again. Okay, there's a couple of reasons for the drop. I mean, it could be we're in a market crash, the industry is down, it's in a recession, the company might have made a major acquisition. So any number of things may cause the earnings to go down. And in this case, we see with CN Rail, the earnings do drop, but then they come back up again. And as long as the earnings are growing in the long term, then we can feel confident that the dividend is going to keep going up. Okay, we're dividend investors. Our focus is on the dividend, is on generating passive income. Our focus is not the stock price. So that's why I'm going to look more at the dividend line, which is the orange line here, and I'm going to look at the earnings line more so than I will look at the stock price. Okay, so those are the three things that I promised in this video I was going to cover with you. So we've covered the three top concerns when it comes to dividends, right? So dividends people think are insignificant, and I showed you that they're not. You know, dividends are not guaranteed, but I showed you that if we look at the history of companies that have been paying dividends for over 100 years, that we can feel confident in getting our dividend every year. And then I just showed you what happens to this dividend when the stock price drops. And in the companies that we look at, they're not affected by the stock price tanking. The dividend keeps going up. Okay. Now I want to share with you the top three awesome things about dividends. We're dividend investors, so I couldn't help put this in this episode here. So I want to share with you, just take a couple of minutes, and I want to go over the three awesome things about dividends. Number one, it's an immediate return on your investment. Okay, while you hold on to those shares. Share price can go up and down, but as long as you own the shares and as long as the company is paying the dividend, that money is going to get deposited electronically into your trading account. So that's number two, which is cash in your pocket. You can spend the money if you wish, or you can reinvest it, but it's yours to keep, right? And that takes me to point number three. Once the dividends are given out, the company can't take it back. So if a company was to go bankrupt, I know with Enron, history is filled with companies that have gone bankrupt. But when that happens, they can't come back to you and say, hey, well, you need to pay back the dividends. No, the dividends you've received over the years are yours to keep. So I showed you my example earlier with TC Energy. I invested $2,479 and I got back $8,000 in dividends. So that money is mine to keep. In fact, I've reinvested that money over the years into other stocks that pay dividends. I've taken those dividends, reinvested them into other stocks that pay dividends. So in fact, the return from TC Energy to me has been way more than $8,000, right? But let's just stick with this example. And so the company alone has paid me $8,000 in dividends. So they can't be taken back. So that's kind of your insurance policy, if you want to think of it that way, or a margin of safety, right? So I showed you before with TC Energy, I bought the stock at 13. The stock is now trading at $64. I don't really care if the stock price drops to 30 or 20 or 15. I've already made my money back. So the dividends are your insurance policy. They also reduce your risk. Every time a company pays a dividend, your risk goes down. Every time the company increases a dividend, your risk goes down. Okay? So I just wanted to share these 3 awesome things with you. Now, so what does this mean? Does this mean you should go out, buy any stock that pays dividends? And the answer is no. Okay? You want to make sure that you're investing not in any dividend stock, but in quality dividend stocks. And you want to make sure you're buying those quality stocks when they're priced low. So anyone who's interested, I cover the undervalue, overvalue is covered in episode 1. So go take a look at that. But how do you know when you're looking at a stock if it's a quality stock or if it's a non-quality stock? So for that, I created what I call the 12 rules of simply investing. So before you invest in any stock, make sure it passes all of the 12 rules. If it fails even one, move on to something else. Okay. For those of you listening to the audio version, I've got the 12 rules up on the screen. I'll just go through them very quickly here. Rule number 1, do you understand how the company is making money? Rule number 2, 20 years from now, will people still be using its product and services? Rule number 3, does the company have a low-cost competitive advantage? Rule number 4, is it recession-proof? Rule number 5, is it profitable? Rule number 6, does it grow its dividend? Rule number 7, can it afford to pay the dividend? Rule number 8, is the debt less than 70%? Rule number 9, avoid companies with recent dividend cuts. Rule number 10, does it buy back its own shares? Rule number 11, is the stock priced low? And again, I covered that in episode 1. Rule number 12, keep your emotions out of investing. Okay, so there you have it. For anybody who's interested, want to go into more detail in the 12 rules, I cover them in the Simply Investing course with real life examples. And in the Simply Investing platform, we automatically apply the rules to every single company in the US and in Canada. And then we show you which companies to consider for investing and which ones to avoid. And you can see which rules they pass, which rules they fail. Everything is highlighted, so we make it really easy for you to sort through that. I want to thank you for watching this video or listening to the podcast. Make sure you hit the like button, hit the subscribe button as well. For more information, check out my website, simplyinvesting.com. And I've got a lot of great future episodes planned for you. We have new episodes out every week. So thank you for watching, and I'll see you next time.